Hello, how are you? Welcome again to yet another series of investment, retirement, and insurance presentations by Holistic Insurance Solutions. This is a presentation that is targeted to those of us who are 35 years and below. And I have categorized, or I have done this presentation for this particular sector of our clientele so that we can zero in on what is mainly relevant to them, because we realize that some products are more applicable to a younger person than to an older person. And therefore, I would like to dedicate this to the younger people, that is 35 and below, and those are the people who are in their formative years. All people who are in the age bracket that is in the process of establishing itself in life. If you allow me, I'll share my screen so that we can move together. Just a second. Yeah, I hope it is visible to all of us. So basically, this is a presentation by Holistic Insurance Solutions. And like we had mentioned in other presentations, our main mission, our vision and mission is to empower and enlighten our people on how to access insurance, investment, and retirement products which are right for them. We appreciate this is a technically quite a technical field, but unfortunately we just have to understand it because it is part of our life. And these products are mainly do give us three main objectives. The first one being creating wealth, eliminating or protecting that wealth against adverse exposure to risk, because it is possible to struggle and put your wealth together, and you are operating in a risky on a risk infested environment, and because of that, whatever it is that you have put together could be eliminated or wiped out because of risk exposure. And the third item is that we aim at empowering our people so that they keep old age poverty in abeyance. The three, that is insurance, investment, and retirement, are very, very interdependent, and they are inseparable. You can see the demonstration picture on my right is actually showing a rope that is a 3-thread rope, which actually is the three strands actually combine make one strong rope, and one cannot do without the other. So in the same way, a strong financial strategy for a corporate or an individual must have all these three elements. That is, you must have the insurance aspect, that is, you should create the wealth, protect it, and also envision your future support. Insurance products help us to create wealth And they also help us to protect this wealth against loss of life or even disability risk. And you can add their morbidity risk when it comes to health insurance. Investment products help to preserve the wealth that we have created against inflation, because what inflation does is to erode the value of your investment or your asset or even your wealth. Retirement products, as the third element, helps you save and invest for funds that you can live on in the later years. When you actually retire and disengage from active employment or regular work, or in the unfortunate occurrence of incapacitation, which could arise from illness or accident. So it is possible for a person to retire earlier than the age that they anticipate. So if the retirement age is, you aim to retire at age 60, it is possible to find yourself retiring at 45, 50, or even 55, depending on the circumstances that come into play in your life. So I would want us to address a very critical element, and this is called the wonder of compound interest. Compound interest, what we have tried to demonstrate here is compound interest against simple interest. For example, when you put your money in a bank account or in a bank deposit, what happens is that it earns interest at a simple rate. But when you invest it in a retirement product or an investment product, it earns interest at a compound rate. And what this actually means is that in the interest that is created or credited to your account is capitalized and it forms part of the capital amount on which the basic amount is created. The first part we are showing interest earned without additional contribution. That is, if you decide you're just going to put, for say, 10,000 in an account and leave it for a whole year, and you don't put in any additional money, this is what will happen. If it is earning interest at a compound rate, that is the green line, it will grow. You see the interest will be growing. But if it is at simple interest, this is the black line, it will be earning interest that is static. If, say, for example, you put this amount for a longer period and leave it to run, say, for a decade or for 10 years without putting any additional amount, you can see the significant difference in terms of the investment, in terms of the interest, growth in interest. The compound line is actually, you can see how it grows. You could also choose to invest and also put in some additional contributions. If you put in additional contributions, instead of just putting one amount, you can see the graph will be going up. Even the black line or the simple interest element will be going up because of the additional amount that you have put in. So it is advisable that when you are investing, you make a commitment to put in regular periodic payments. You can see the way interest is growing. I would like to demonstrate, if once you get access to these presentations, you'll be able to interact with these slides, just to see. If you click on the link, you'll be able to open the source of this graph, and you'll be able to see how it is compiled and how it is actually growing. The first sheet is showing compounded interest without adding any or putting in additional funds, and the second one is showing the growth in interest, both compound and simple, when you put in additional amounts. Yeah. So that is compound interest, and basically that is how it operates. So the next presentation, or the next slide, I have shown you, for example, if your benefits, you take benefits, for example, in an insurance product, that is assuming that you invest in an endowment policy, which pays you a lump sum benefit at the maturity period. Sorry, the maturity period. We have chosen 3 scenarios, and all of them are investing for 10 years term, and they are putting in a monthly premium or contribution of 5,000. The first one is a person who is aged 45, and it means for the 10-year policy term, the maturity of this policy will be at age 55. The second one is 35 years old, and the policy will mature when he is 45. The third one is 25 years old, and his policy will mature when he is 35. So what we are saying is that what we are trying to demonstrate here is that the earlier you start, the better. So if you can take up your policy or sign up for an insurance policy when you are in your 20s, you can see the maturity benefit or benefit payable at maturity, or in the event of death, if the life is cut short within the 10 years period. This is the amount that will be paid to your beneficiaries. If you survive to the end of the 10 years, this is the maturity benefit that will be paid to you. And the maturity benefit includes bonuses that are based on the sum assured. So most people ask the question, what is the investment return? If you look at, for example, when you are looking at an investment product or a retirement product, you can talk about interest. But when you are looking at an endowment life policy, you talk about the bonus. The bonus is based on the sum assured of the policy, and it is declared on an annual basis depending on the profitability of the life office. And you can see the younger person, his policy matures to a bigger amount than the older person, because when life policies or life benefits are dependent on age at which you take the policy. So when you take the policy, when you sign up for a policy earlier, it pays a higher benefit at maturity. The difference may look like it is not very significant, but when we look at the next slide, because we will be saying that this person receiving his benefits at 55, assuming he would want to invest this to supplement his retirement account at age 60, let's see how it behaves itself. For the person who is 55, it means his benefits will only be invested for a 5-year period. And during at age 60, he will actually receive 967,000. For a person who is 45, it means his benefits, although it's of 674,000, will be invested for 15 years, and it will mature to 2.1 million. The person who is 25, it means he will have a whole 35 years to invest the funds, and it will, at 60, he will get a lump sum amount of 4.6 million. Okay, so this is now the area where you are able to clearly see the earlier you receive your money and invest it, the longer the investment period, the higher the amount that you get at your retirement. We'll look at, this is a demonstration of the same fund of the 25-year-old, which was 677,000. And you can see this person has taken the money and put it in a money market, and it has been invested to give him an estimated future value of 4.6 million, which is actually reflected in the table that we showed below. Okay. If you take, for example, somebody who does not, assuming now you do not take a life policy, and you decide straight to go to an investment policy, and you invest an amount of 3,000 every month for a period of 25 years, you will have an estimated future value of 2.8 million at the end of the 25 period, if you have invested this money in the money market. Okay. We see another scenario. If this person, assuming the person who was 25, instead of purchasing a life policy, if he straight away took 3,000 and put it in a money market, this is what it would become: 6.8 million at the age of 60. That is after 35 years. Okay. Remember, this person was investing his funds at a rate of 5,000. Assuming instead of putting in 3,000, he still puts up 5,000 for the same period of 35 years. That is during his age from 25, every month up to the time he is 60. This fund will have accumulated to 11.6 million. And this is purely because of the compounding element. You can see the interest earned for the full period is actually 9.3 million. So what are we talking about? What we need now to do is to ensure that you select a product that is suitable for your needs. Insurance products will help you mitigate risk on premature loss of insured life. It will also help you create a fund for specific needs. Assuming this person who is 25, if he targets, for example, to invest in a home and he will need a deposit, this policy, when it matures, it will give him a lump sum amount which he can put in or supplement his deposit for a home purchase. You can also use it to set up your emergency fund. That is, you create an account, an investment account, which actually backs you up and ensures that anytime you have an emergency, instead of dashing to a friend or even to the bank where you are charged interest for the loan, you can go to your investment account and get some money, and that money will be of great assistance to you. Retirement products, these are very long-term. That is, insurance products and retirement products are long-term investments, and they help you save and invest funds that you live on in your later years. That is when you are not as strong to continue working, or if you happen to get incapacitated and you have to terminate regular working. And at that point, you need now to start drawing an income. So the fund that you will have accumulated is what will be converted into a regular income through a product we call annuity or income drawdown, depending on your preference. Investment products will help you mitigate against loss of value for your funds to inflation. And it also helps you accumulate, protect those funds that you have accumulated, maybe even through insurance and other avenues. You could also be having regular income generating activities, for example, rent a property or proceeds from a business. You can actually invest it in a money market, and that will ensure that your earnings are actually protected from inflation. There are tax advantage or tax advantages that pertain to the life products. One, the premium that you pay. A certain percentage of it, currently at 15%, is treated as a deductible, subject to a maximum amount set by Kenya Revenue Authority. And this is actually, if you are employed and you submit this to whoever processes your payroll, they can remove 15% of your premium or the money that you are paying for your life policy before, or treat it as a deductible when they are working out your tax. So it helps in reducing your tax liability. Again, benefits that are paid from a life policy, whether it is in form of death benefit or maturity benefit, it is tax-free on the recipient, whether the recipient is a beneficiary or the policy holder. Then retirement contributions. When you make contributions to a retirement program, you are entitled to currently to a tax-exempt amount of 20,000 per month, and annually 240,000. So even when you are making your tax returns, you can use, you normally reflect the amount that you have contributed to a scheme as deductible. If you are employed and your employer, you can submit that a certificate. You can be issued with a certificate that you give to an employer, and the employer will treat that amount which he deducts from your salary to remit to your pension scheme or to your retirement, or for your retirement contribution. It can be used, treated as a deductible when your tax is being calculated. When you retire, there are benefits that are subject to tax and benefits that are not subject to tax. Benefits that are subject to tax are called registered benefits, and that aspect of your benefits, you are entitled to a tax relief of 60,000 for every year every year of pensionable service that you have served under the scheme. Registered benefits also, you can defer those benefits and access them at 65, provided you access them as a retirement income in form of annuity or income drawdown. You are entitled to get them tax-free. But of course, if you access those benefits as a lump sum, they are subjected to normal tax treatment. Okay, so the question now is, what do I need to do in order to get started? One of the first thing that you need to do is to decide on the product you wish to take up, depending on your needs. Either it could be either an insurance cover to cover longevity risk, because you don't know what will happen tomorrow. You could also take an investment product, protect erosion of your asset value by inflation, or retirement of accumulated, retirement to accumulate funds for your later years, of which you can use in your later years. Then you, after you have selected the product, you'll be provided with an application form or a proposal form, which you will populate with your personal details and limit of your contributions and all the questions that you'll be asked. You populate and also make the initial payment. The initial payment will be made directly to the company, not to the agent. It should be made directly to the company through the provided company's pay bill. Of course, the pay bill will depend on whether you are paying for insurance, investment, or retirement. Each account, each fund is accounted for separately, and it is also paid separately. And once you make that payment, complete the application form, you attach the KYC documents, that is the KRA PIN, the national ID, bank account card, that is the front side only, not the side with a security PIN. And then for retirement and life insurance policies, you attach a passport size photograph. This is because those products are very, very long-term oriented. If you wish to access more details or more information on each one of the three products, that is insurance, investment, or retirement, you can just click the holistic insurance website. If you click it like that, you'll be able to view our different products. The first category is actually insurance. And when you click, for example, where we have written see details, you'll be able to get a whole presentation showing you how insurance, or demonstrating or explaining how insurance protects loss of income, against loss of income. The other one is how insurance protects against loss of health, and it also protects against the loss of life. And when you click details here, you are able to get into a full presentation, almost similar to this. If you play, you would wish to watch the playlist, you click the playlist and you'll be able to see the presentations. Okay, so that is what you expected to find. And then if you have any questions, my contacts are there. The email address is also included. You can also click here, any of these buttons. If you click the first one, if you click the first one, you'll be able to it will take you to a place where you are able to send an email. You see it takes you to a position where you're able to put in an email. You can also click the second one. The second one will give you a form where you can leave your details. And at the end of this form, you submit. And when you submit it, you'll come to us and you'll be able to see it. And you'll also give us your areas, the areas that you want us to address. For example, if it is insurance, investment, retirement, or any other, you'll be able to indicate there. And if it is any other, you type in here and then you submit. When you submit, the form will come to us. If you do the last one, you'll be able to chat with us on WhatsApp, and you'll be able to communicate, and you'll be able to put your concerns there, and we'll be able to respond to you. So I think with that, I would imagine that we have done a fair presentation of the different products, and that will be able to give you an idea of how to get started and how to move on. And once you contact us with your request, we'll be able to guide you accordingly. And with that, I would really appreciate for taking your time to listen through the presentation, and look forward to hearing from you through email or the form booking, session booking form, or even chatting us up on WhatsApp. And I believe we will be able to create a product that is suitable for you to help you manage your financial strategy. And with that, I think I would just say, I would close at that, and do appreciate and thank you for watching and also for following this. Thank you.